this is Brian Resney, president of Resney Wealth Management, bringing you an important update about the economy and the investment markets. The U.S. economy continues to demonstrate remarkable resilience. Private sector jobs added 172,000 in January, more than double expectations of 70,000. Bottom line, the employment situation in the U.S. looks very vibrant, and I know there's been a lot of talk about unemployment and people losing their jobs because of AI. To be brutally honest, we're not seeing that. So we're firmly 2 years in to what we call the AI revolution, and are we seeing really any changes from employment, people losing mass amounts of jobs? No. What we are finding, AI, at least the initial versions, are adding quite a bit to productivity, which is very profitable for companies, which ultimately leads to potential higher stock market prices, more returns in your portfolio. The overall labor force participation is at 62%, up modestly. These are all good things. This means people that want jobs are finding jobs and are looking for jobs. In fact, currently there's more jobs available than people that are looking to fill those jobs. Bottom line, notably, all net jobs in January went to basically native-born workers. What does that mean? All the jobs that are currently being filled are from people in the U.S. that are actual U.S. citizens. This is a very good positive. What we've seen on the front when we look at illegal immigration is people are self-deporting, and of course we're deporting people that are the bad actors in addition. And somewhere around, they're saying 2.5 to 3.5 million people now have either exited the U.S. in the last 12 or so months, either willingly by themselves, a lot of those actually, and or have been deported, the bad actors. Construction's a big one. We're adding jobs in the construction market, and this is a really good positive. What does that mean? We're adding real jobs to the economy. Construction jobs are kind of those hands-on jobs. Manufacturing type jobs. These are all positives. From a fiscal perspective, the latest CBO projections show the U.S. trade deficit at about $1.9 trillion. Or 6% of GDP, above historical comfort zones, and I will say that. So we are always concerned about big deficits in the U.S., but these will get handled, in our opinion, over time. Public debt is projected to rise to about $31 trillion today, from $31 trillion today, to about $56 trillion by 2036. With an average addition of about $2.5 trillion a year. So the bottom line is debt is looking to increase. These are areas we don't want over time. The key to bringing down debt is GDP, gross domestic product. If we can increase gross domestic product, that will help bring in more tax revenues to the government, which hopefully will bring down some of the overall debt. And also, if the government actually continues to stay on track and bring down expenses over time, that will also contribute to bringing down the overall debt. I'm particularly encouraged with AI spend. Let's talk about this a little bit. Right now, it's projected that AI spend just this year is going to be somewhere around $600 billion. $600 billion. Think about that, folks. That is extremely powerful to the GDP number. That actually will add to about 2% tailwind to the current GDP numbers. So when I often talk about the gross domestic product in the U.S. and how it's grown and what they're projected at around 2%, we feel that we could easily hit 3.5+% this year and probably the next 3, 5, and 10 years in addition to this year. Recent GDP, third quarter and fourth quarter 2024 exceeded well over 4 and 5% on an annualized basis. This is very positive. With interest rates, we're expecting cuts as we get into the January timeframe. So ultimately, bringing down interest rates will bring down costs to the government debt, which is obviously a lot. Also will bring down the cost to consumer debt a lot. We'll put more money in the consumer pocket, which, remember, the consumer is 70% of the U.S. economy. The consumer likes to spend money. These are very positives. In the midst of recent market turbulence, remember, we've seen volatility, folks. It's normal. In fact, this year is positive for the S&P, but we're kind of doing this up and down treading water. I want to bring this to mind of every client. Markets don't go straight up every single month or every year. We could actually have a year in 26, this year, where the market does this. for 8, 9, 10 months and then takes off again. This is normal. Returns are not month by month, quarter by quarter. They're year by year and realistically rolling 3 and 5 year segments. So remember, as a client, do not expect every month that your account goes up. You might 3 or 4 months where your account goes down 1 or 2% before it goes to that next high. Everybody's talking about that Magnificent Seven group, which has lagged the broader market. But what will ultimately happen? We look at large cap growth in the U.S. economy as really being the growth drivers. These are the companies spending the most amount of money on AI. That money will come back to them in productivity and future earnings growth. This is highly positive. Much of the selling that we've seen in the market and the volatility is widespread fear. So basically we call it throwing the baby out with the bathwater. And as a great example, software stocks are down 35% year to date. We really don't own any software stocks in our portfolios, but as a sector and a group, they're down quite a bit because AI is going to get rid of every software company. Simply not true. Technology revolution from the internet, and remember the personal computer days back in 2000? Transformation is always going to be a little lumpy until things basically get a little more solid and take off. So remember that. All transitions of a growth economy, and in our opinion, we're in the fourth really industrial revolution for the U.S. This is going to be multi-decades long, probably the best opportunity the U.S. has seen in probably since World War II to grow the U.S. economy. Remember, the U.S. economy grew at about a 3.5% GDP rate up until 1999 after World War II. Since 2000 to current, we've grown GDP only 2%. I think we could easily get back to 3.5%, 4.5% GDP growth in the future. That is going to be huge for the U.S. economy and for the profits of large cap companies. In my experience, AI is not a zero-sum game. There's going to be disruptors and there's going to be companies that are going to be eliminated. That's how business works. If you look at car companies, there's car companies in business today that weren't in business 20 years ago, and there's car companies that were in business 20 years ago that are not in business today. But overall, the economy grows. Why are we optimistic for a 3.5% GDP growth this year? Simple. Robust consumer spending. Massive capital spending boom. I talked about $600 billion. Onshoring back into the U.S. Think about this, folks. For decades, we gave all of our business to all these other countries around the world to manufacture. These things are coming back already. Think about how much more productive we're going to be this year and how much more things are going to be manufactured in the U.S., not only this year, but over decades to come. Productivity gains driven by AI adoption is going to be huge. Supportive fiscal stimulus and pro-growth policies under the current administration. Folks, I've been managing money for 35 plus years. I have not seen this kind of fiscal stimulus and pro-growth policies from any administration for 35 years. This is going to solidify the U.S. economy and really give us a chance for above average growth on GDP. Accommodative monetary policy, strong energy sector spending. We're spending billions, if not trillions, on growing the U.S. economy energy sector. This is big. Cheaper energy prices, more money in your pocket, and businesses, more profits. Trade rebalancing. We've had actually the lowest trade imbalance that we've had for decades because of the current administration. These are positives for U.S. consumers. Resilient corporate earnings fueling further business investment. Overall economic resilience returning to a historic 3.6 average growth pace after 2 years of slower expansion. Bottom line, the U.S. is poised to grow the economy better than it has for decades. This will lead, in our opinion, to more wealth created for the poor, the middle class, and always the rich. Remember, the U.S. from 48 to 99 grew approximately 3.5% on GDP growth. From about 2000 to 25, our economy only grew about half of that. Think about doubling the GDP growth the next decade, 2 or 3. The golden age for the U.S. is upon us, And if you're invested properly and you're not worried about short-term volatility, ultimately, in 3 to 5 years, I firmly believe we're all going to be substantially wealthier. We have a U.S. economy that's firing on all cylinders. This doesn't mean that we won't have normal volatility. Expect a 10-15% pullback sometime this year, but rest assured, if you're not worried about your portfolio, what's going to happen today, tomorrow, or next month, over the next 3 to 5 years, as I stated, you ultimately, I believe, will be a wealthier investor. That's how wealth is built. Remember, 6 steps up, 2 steps back, normal correction yearly. That's how RESNY Wealth has built wealth for 35 plus years. We thank you for your business and trust. As always, we grow our business from exceptional clients like you. Please refer your friends and family members so they can be treated with the same kind of respect and quality management you're receiving. And make sure you forward this educational video onto your friends and family so they can get the same quality education you're receiving. Have a safe and profitable day.